Traders Corner is proudly brought to you by IG, the specialists in CFD trading.
Welcome to Traders Corner. As always, I'm joined by Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, we had whiplash markets last week, so quite tricky to trade them unless, of course, you managed to catch the swings in the right direction. And you actually went long on the show last week. So how did that trade pan out for you?
Yeah, it's actually worked out quite nicely for us. If we have a look at the screen now, this is the trade that we did. It was a long trade on the top 40, but specifically we did a long on the IG markets micro CFD. Now, what that micro CFD is it's a CFD contract where each contract has a contract value of R2 per point. Okay. So it's quite a small contract size, and we did 2 of those contracts. So in essence, we went long of R4 per point on the top 40. Now, if you have a look at the graph, what you can see here, this is actually a chart of the top 40 futures contract, which is what I like to do my analysis on. And what was interesting last week was that the market broke above this downward trend, which had been in place since sort of early last week. We saw that big sell-off into Wednesday of last week, and then the market rallied and it rebounded. Now, we got long basically on the basis that we had this large island reversal on the top 40. Now, what an island reversal is like that, where you see a gap down, as we saw on the biggest day of that sell-off last week.
Which was, what, Monday? Yeah.
Yeah, that's right. It was Monday. Then you had this gap up on the Tuesday. That's right. And so the gap down and the gap up make that body of trade look as if it is actually broken away from the rest of the trading action. And that's hence the name an island reversal. And these typically are quite powerful reversal signals, and especially if that breakaway gap on the right-hand side of the island reversal doesn't get filled, then very often that actually results in quite a nice follow-through move to the upside. So we went long on the basis of that island reversal, and as well as the fact that the market had broken that downward trend. And we went long 2 contracts of the micro CFD, and the R2 micro CFD, so 2 contracts times R2 per point is R4 per point, what we went long of. We did that at 42,805. And my stop loss was at 41,900, which would have meant then that the market would have had to go and close the gap of that island reversal and go below that gap. Okay. Now, that hasn't happened, and it's actually worked out quite nicely. You can see the market's drifted higher throughout the last week or so, and we've made some money on this trade. Today, the market is coming off, and it's quite weak. Now, what I did early this morning is I actually closed this trade. Regular viewers will know that I was looking for a move higher. I was looking for a move up towards about 45,000 up here. And we didn't get that. We got to move to close to 44,500. And now what's happened is the market appears to be making lower highs and lower lows now. And it's actually broken this little upward trend, which I've drawn in over there. Now, that for me is concerning. And in a market like this, which is generally a bit iffy, I don't want to be too greedy when it comes to profits. It's not really a market which is conducive to running profits, particularly on the long side at the moment. So when I saw that breakdown, I thought maybe we just take our profit here and be done with it and be happy that we've got something out of it. So I've closed out at 43,965 earlier this morning. And that has allowed us to bank a profit of 4,640 Rand once all costs have been taken into consideration. So not a bad little trade there. Yeah. I'm happy with that. We've capitalized on a bit of a bounce in the market. And then it also reduces our exposure on the long side in the overall portfolio, which is also not a bad place to be, given that it does seem to be taking a turn lower again.
Yeah, okay, well, so, I mean, not bad for a couple of days trading work. Yeah. Garth, let's talk about the top 40, and I know you want to look at the top 40 index, the bigger picture, as it were, which we do most weeks. Yeah, if it starts breaking down here, August as a whole was a bad month. Last week was actually a very good week overall. Yeah. But what do you think lies ahead?
Yeah, I mean, look, if we look at this picture, it's still not really a great picture at all, I must say. We've still got this big head and shoulders pattern, which we've discussed so many times on the show, that has broken down. It's gone below the neckline. It's gone and met the target of the head and shoulders, which corresponds with all these lows that we saw in October, December last year. Now, and again in August, we've been down to those lows at about 41,500, or just below that. Now, the market's bounced. We've bounced from there up to about close to 44,500. And we now seem to be stalling at the moment. So we kind of stuck in the middle of this range, somewhere between 41,500 and up to 45,000, this sort of area. That's really where we're at the moment, between that support and that resistance area. we've taken a turn down today, and we seem to be stalling a little bit. I don't know whether this doesn't turn out to be sort of like an A, B, C kind of move. So in other words, we've had that big leg down, then we get an A leg up, a B leg down, and then a potential C leg to take us back up to 45,000. I don't really know. I mean, I'm being a little bit, I'm guessing a bit here, I suppose.
Well,
but
I suppose it is one big guess.
Yeah,
I mean,
it is. But I think broadly speaking, this market still doesn't look fantastic. We are coming a bit lower today. Whether we're going to bounce off of these levels or go, it's quite honestly, it's a 50-50 right now. We're right in the middle of that range between 41,500 and 45,000. It could go higher or lower from here. It's very difficult for me to say with any certainty which way it's likely to move right now.
Well, the fact is that you've got this option structure. So actually, if it stays in that range, at least for the next 2 weeks or so, then it will pay off for the portfolio.
Yes.
So just tell us, just remind us, where the payoff profiles are.
Yeah, this is a put spread option structure that we did on the show some time back, and this runs out to the September futures closeout, which is on the 17th of September, so just over 2 weeks' time. And it involved the sale of a put option, or sale of 2 out-the-money put options, and a purchase of a 46,000 strike put option on the top 40. And we paid 3,500 Rand away in premium to get that protection. And then it makes its maximum profit between 42,000 and 44,000. But I mean, actually the structure makes money anywhere between sort of about 45,600 and all the way down to 40,000. So it gives us a nice broad profitable area. And yes, you're right, provided the market stays somewhere around about where it is at the moment, we're sitting quite pretty with the structure at the moment. Right now, or certainly when I prepared these slides this morning, the market was trading at around about 43,800. It's a bit lower than that right now. But nevertheless, that puts us right smack bang in the middle of that profitable zone, or that maximum profitable zone. Call it the sweet spot, if you like, where we incur a mark-to-market profit of 16,500 Rand. So I've marked it to market as at that price, because that's where what we would make if closeout was today.
Yeah.
But the reality is that, because of course the obvious question always is, well, then you've got your maximum profit, why don't you just take it and walk away? It's not as simple as that. With these options, because of the complexities of options pricing with volatility and time value theta, et cetera, it's not as simple as just closing the options out now and getting our profit. If I was to close them out right now, I would get substantially less than that. But if I run it out to close out, which is what I'm intending to do, this is the linear payoff that we would see on the futures closeout. And that's what I'm essentially holding out for with this structure.
I mean, it would be nice, to say that you'd done it with the intention of making a big chunk of profit, but it was also a hedge. Yeah. So if it runs out and unfortunately it's not in the sweet spot, oh well, it was a hedge which kind of gave you a bit of protection in the event of a market downside that you would have confidence to go and put on other trades on the long side. Yeah. So,
Well, that's right. I mean, that's exactly right. It was put on as a hedge, and if you look at it in another way, like we've got on the screen there now, you can actually see this is this payoff of the option structure overlaid onto the top 40 graph. And you can see again, we're right in the sweet spot over here at this stage. But yes, it was put on as a hedge, but it's also put on with the intention to make some profit if the market goes down. Sure. And a lot of people always say to me, well, if you've got a bearish view on the market, why not just go short? And my answer to that is that, look, I'm not a naturally bearish trader by nature. I'm more of a bull by nature than a bear. But if we're going into a bear market, you'll certainly find me putting on more short trades. But historically, I've not been a big fan of just going naked short, because if the market rallies, then you end up losing on the short. Obviously, if it goes down, you make money on your short. But when you do it like this with an option structure, you can quite comfortably put a trade on like this, know what your risk is. So in this case, we know that our risk was the premium that we paid, 3,500 Rand, and that's gone goodbye. If it falls into our sweet spot area, then we make the profit. And for me, it's the kind of short trade that I can put on without having to lose any sleep over it if the market rallies. And that's what I like about this.
Yeah, well, let's hope it does close somewhere between 42 and I suppose 44,000.
Yeah, that would be ideal.
It would. Now, Garth, what wasn't ideal is what's happened to your pairs trades. Tell us about this, because it's actually, it's one of the, you've ended up losing a bit more than you would have wanted to.
Yeah, these kind of trades are always tricky, and it's especially difficult to, call it even embarrassing, if you like, because a lot of people always say to me that these pairs trades are complicated. Why do you do them? And then, you try and explain your way around it. Because quite honestly, pairs trades, I do like pairs trades, and often there's good opportunities to make money on pairs trades. We've done the Zeder and Pioneer Foods pairs trade earlier this year and made nice money off of it. But nevertheless, it is quite a complex trade. And then to come back and say, well, we've lost money on it. And not only have we lost money, we've actually lost a bit more than what we intended to lose. Well, that's a little bit of a humbling experience. But anyway, allow me to...
Everyone's got to eat humble pie now.
Well, exactly. But allow me to talk my way through it and
Okay.
what's happened here and why we did the trade in the first place. Now, look, Zeder and Pioneer Foods are two stocks that are very closely related. Zeder is an investment holding company with assets in the food processing business, and Pioneer Foods is a big food processing business. Pioneer Foods is the biggest holding within the Zeder stable. About 75% of Zeder's market capitalization is made up of its stake in Pioneer Foods. So naturally, you would expect the share prices of these two companies to track each other very closely. And typically, that is exactly what they do. You can look at this graph. That graph goes back 1 year, and you can see how closely the share prices generally do trade against each other. Yes, there's times where the gap opens up, but typically it always comes back together at some point. Now, recently what we've had is a situation where Pioneer Foods has opened a significant gap over Zeder. And you can see that gap illustrated over there. And in fact, this gap is wider than I've ever seen it at the moment, which makes very little sense because, as I said, the two companies are so tightly correlated that the two share prices should track each other. There's no good reason not to. However, what I didn't realize at the time was that Pioneer Foods has been included or has been upweighted into the MSCI emerging markets indices, and therefore there has been quite a lot of buying of Pioneer Foods during the last couple of weeks since we put this trade on. And that's propped up the Pioneer Foods share price. Meanwhile, the Zeder share price has been falling. Now, look, that still doesn't explain...
I mean, and it doesn't make sense because Zeder should have actually rallied along with Pioneer.
Yeah, well, exactly. They should track each other quite closely. If we look at this graph another way and show the trade that we've done. Now, this is a relative graph of Pioneer Foods divided by Zeder. And you can see, certainly going back 3 years here, nearly 3 years, the ratio between the two shares has been very consistent. It's oscillated between 18.5 and 22.4. To get this, you take the share price of Pioneer Foods and you divide it by the share price of Zeder. And when it gets to the top of that range, typically you can short Pioneer Foods and go long Zeder. And when it gets to the bottom of that range, typically you can go the other way. You can buy Pioneer Foods and go short Zeder. Now, when it got up towards this area here, it had broken out. I thought, my goodness, that is ridiculous. It's gone out so far. This ratio will come back in line at some point. And we put the pairs trade on where at a ratio of 24.05. So what that meant is that we sold short 731 Pioneer Foods CFDs at 205.20, and we bought 17,585 Zeder at 8.53 Rand. The nominal value of each side of that trade is 150,000 Rand. So we were short 150,000 Rand of Pioneer Foods. We were long 150,000 Rands of Zeder. Okay, and the ratio has moved out. Well, the stop loss was a move beyond 25.
And unfortunately, Garth, you let's... Okay, so you wanted to give yourself a bit of wiggle room, but you've lost more than you had intended to.
Well, that's it. So I've ended up closing out with the ratio now 25.74. Why did I give it some wiggle room? Well, because of this rebalancing and the MSCI rebalancing. I thought that this was unlikely to be a prolonged thing. And if I'm very honest, in fact, I wouldn't be surprised if I'm cutting this trade at exactly the wrong time now. But you know, the one thing we have a reputation for on this show is being very disciplined and sticking to our rules. As it is, we've kind of been a bit naughty here because we've lost 10,700 Rand, when in actual fact, originally when I put on the trade, I said I was only willing to let the loss go to 6,000 and then I would cut it. So we've lost a lot more than we should have here. You know, and then for me to come back next week and say, oh, well, no, we've actually lost even more, that certainly would throw my credibility out the window. We have to be disciplined and we have to cut the losses. So we've made a loss here. Look, it's certainly not a catastrophic loss, but it is more than what I was wanting to take. It's just over 3% of the value of our equity, which is not ideal, but certainly not the end of the world.
Garth, I've sort of misjudged our time, so unfortunately we have to cut it there. It has had a slight impact on the portfolio, which is only up 43.8% in the year, but we'll have to leave it there, and we'll be back next week, Tuesday.
Great.
Garth Mackenzie is founder and editor of Traders Corner.
Traders Corner was proudly brought to you by IG. Visit igmarkets.co.za to open a trading account today.